And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is the Wednesday edition of The Real Investment Show. Danny Ratliff joining me this morning. Just really kind of catching up on things. Yesterday, markets did rally a bit, coming off the lows. Now, again, yesterday morning, we were actually selling off pretty decently in the morning. Rallied back on news, kind of some comments from Jerome Powell's speech yesterday, talking about the potentially stopping QT. And this is something we've talked about before, and we'll dig into a little bit of what that means this morning for a variety of things. But that gave the market some lift yesterday and got markets back. Again, we'll kind of go through the technicals here in a second. But outside of that, we're still pretty much devoid of most of the economic data. October the 24th, though, we are going to get the inflation report. That'll be 2 days before the Fed meeting. But the government is going to release that CPI data on the 24th of the month. So again, that's coming up. But right now we don't have really any other government data to work off of at this point. So we're looking at a lot of alternative data. Interestingly enough, the NFIB report came out yesterday, and that's the National Federation of Independent Business. They survey small and medium-sized businesses, mostly non-publicly traded companies. So these are private businesses of the most part that belong to this kind of small business federation. And they serve them, ask them a lot of questions about, what's your access to credit, what your sales look like, what do earnings look like, what do your forecasts look like. And they compile all this data into the survey. Well, that survey actually declined by about 2 points, went from 100 to a 98 yesterday on the overall index. There were some bright spots in the index. Sales expectations were good. But sales expectations are always good. Small businesses always expect sales to be good. That's part of being an optimist. And if you're running a business, you better be an optimist. So they always expect sales to be good. The reality will be to see if next quarter sales actually keep up with expectations. Historically, that's not the case. But the reason I bring this up is that there's a very high correlation between the annual rate of change in the NFIB survey and the small cap index, the Russell 2000 index. And I've laid this graph out previously in previous articles. But right now, we're starting to see that index begin to deteriorate here a bit as we start to head into the end of the year. Economic growth is slowing down. Employment growth has been slowing down. So we're starting to see that index reverse here just a bit. And that may weigh on small caps if we begin to see weaker kind of economic activity. Again, this is the one thing we've kind of really been paying attention to. Expectations right now going into the end of the year are very optimistic for earnings. In fact, earnings revisions have been rising fairly sharply. We'll see if surprises actually catch up with that. In reality, do earnings keep up with these expectations? But that's kind of the big risk for the markets heading into year end. Again, we kicked off kind of the main part of earnings season yesterday. We had JP Morgan, BlackRock, others report earnings on the financial side. Those were fairly strong. We've got more reports today. I believe Bank of America today is this morning. We're going to start to see a lot of the regional banks reporting as well here over the next couple of days. And then next week, we'll start getting into Netflix and some of the other big companies. Next week and the week after are the two big weeks for earnings. By the end of the third week of earnings, so this week, next week, and the week after, we'll have about 80% of the S&P 500 will have reported, and that also opens up the buyback window for corporate share buybacks. And again, as we move into the end of the year, about 24% of all corporate share buybacks occur in the last 3 months of the year. So there's a big buying support for the markets kind of coming in. And so we'll be paying kind of close attention to that. But here's what you need to know before the bell yesterday. Technically, the market's doing very well here. We're seeing retail buyers step in. They're buying the dip as expected. We came down on Friday, of course, as we talked about yesterday. Had that big candle, touched the 50-day moving average, rallied back to the 20-day moving average on Monday. Didn't quite get above the 20-day. Yesterday morning, as we noted, we opened down fairly sharply yesterday morning, but then we got the announcement from Jerome Powell about potentially reversing QT, and that gave the markets a lift, and we came right back off that 50-day moving average. So we've had a double test now of the 50-day moving average, so kind of trying to cement that support right now. at the 50. And what we haven't done yet is get above the 20. However, this morning, futures are pointing decently higher. So there's a very good probability that we're going to climb back above the 20-day. Now, as we talked about in our daily market commentary, this is important because the break of the 20-day moving average is important. There's a lot of money sitting right there at the 20-day moving average. That was kind of a lot of stop losses, a lot of support. So that's why when we saw that break on Friday, it was a big liquidation. Lots of stop losses sitting right there at the 20-day moving average. But we need to get back above that by Friday's close. If we can get above the 20-day moving average, then this kind of bullish trend will be intact. This break will be negated here, and markets should continue to kind of advance further from here. Again, we worked off a lot of that overbought condition, so that kind of gives the market a little bit of lift here as well. So again, as investors are coming in, they're buying this dip. We're seeing that speculative chase continue. We're seeing the same stocks get bought. You know, the Bloom Energies, the Applied Dynamics, those types of companies. That's where investors are piling right back into the same stocks, same trades, the Oklos of the world, chasing that momentum. So as long as this momentum trade remains intact, then the markets are likely going to be fine. And again, you know, we've kind of talked about taking profits, rebalancing risk previously. What we'd like to see here is a little bit more consolidation, work off some of this condition a bit, and then and allow this sell signal to kind of work its process. I don't know if we're going to see that or not, but that would give you a better opportunity to add exposure going into the year end. Now, and this is really kind of the bottom line here, is that we're seeing a lot of buy the dip activity right now. And again, there's nothing wrong with that. There's nothing here technically that suggests you should be selling and reducing risk by any stretch of the imagination. The markets are just fine. They're remaining very well within this bullish trend, but we need to get above that 20-day moving average. If we don't by Friday, or if this market rolls over today, and again, this 50-day moving average is the average to watch. If we take that out, there's a lot of money. There's a lot of volume that trades right at that 50-day moving average. A break of that, you're going to see a lot more supports get taken out and another kind of a further decline in the market. So the next couple of days will be very, very important. And again, the thing you're looking for here to kind of secure your position is we got to get back above that 20-day moving average. So we'll pay attention to that today and see what happens. I'll update you tomorrow when Michael Lebowitz gets here as well. But that's what you need to know before the bell this morning. All right, we'll come back, talk a little bit about Jerome Powell, and dig into some other topics this morning as well. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Hard to believe that about 5 years ago, it was illegal for people to stand within 6 feet of each other. Have to admit, I kind of miss that. I don't really like people. I've determined as I get older. You know, I remember do you remember when you were a kid, Brent, that, you know, your parents would go, "It's 9 o'clock, time for bed."
Oh, yeah.
And that was a punishment, right? And then I was like, you know, when I grow up, you know, I'm going to stay up as late as I want. And I now realize that 9 o'clock is my bedtime.
And that's late.
Exactly.
Funny how that comes full circle.
I know, right? It's like there's a reason they were saying go to bed at 9. That's
Always remember,
you're
like,
supposed to go to bed.
nothing good happens after 10 o'clock or whatever it was.
Exactly.
Yeah.
Do you know where your children are?
Yeah, remember those commercials?
Yeah.
They come on at 10 o'clock at night. Do you know where your kids are?
Creepy.
Now our kids today, like parents, these like, but back then, you know, do you know where your kids are? Our parents didn't want to know where we were. It's like, get the hell out of the house. Don't come home till the street lights come on.
Till dark.
Whatever.
There was a video, the street light.
Yeah, exactly. Yeah. And you know, and now they're like, yeah.
They're going to drag us in now. I think they're already all inside playing video games or whatever they're doing.
Yeah. There was actually an article about that the other day that I was reading. It's talking about the lost 7 minutes. And it's about the fact that, kids used to go out and play and they would spend time outside and now they're spending all their time inside on iPads and social media and all this type of stuff. And there was an interesting survey out that it was like 88% of parents that were surveyed say that there should be a ban on social media for kids under a certain age. And of course, the dissenters were like, yeah, but that, they're just going to find it in other manners. Yeah, maybe. But if you have a ban on social media below a certain age, maybe that's not a bad idea considering teen suicide rates, et cetera, that you're seeing going on.
Well, there are studies emerging showing an adverse impact on brain development for young children.
Right.
If they're on these screens all day long.
No, it's true.
But it's amazing. We have young children and we have a ban on social media. They don't even have their own devices. And, my daughter, who's 12, is consistently asking and puts together, this great list of why she should get a phone. But she's the only one out of all of her friends that does not have a phone.
Yeah.
And so they'll get to school and say, what do you do? Because they have to put their phones up now once they get in. But she's like, well, everybody just sits on their phone. I just sit there and read. I'm like, and I see it. I carpool. We carpool with a lot of kids to sports. And these boys who are 10 and 11 are in the back seat texting each other. My son's just sitting there. But so now he just thinks it's fun to jack with them. He's like, oh, look, there's a bald eagle. Or so it's great.
Well, knowing Abby, she's probably going to come up with a PowerPoint presentation telling you why she needs.
Oh, she has pretty much. Yeah. I mean, it's there. And the time is coming at some point, especially. But the problem is the school requires them to be on devices.
Yeah.
For communication, so many things. And we see it. I mean, the communication aspect, I think most of these kids are really smart and they're good kids. But I just don't want it it's that window of what it opens to.
Right.
That, at that age, they don't need to be subjected to it.
Pandora's box.
Yeah. I guess the only risk you run is that rebellion stage where, they finally get the device and then they run off in the other direction. Because
I think there's probably a little bit of that, but I also think that at some point she's going to appreciate it. Because I said, listen, there's going to become a time that you're going to be glued to this phone. I am tethered to it. Yeah. Think about it. I mean, anywhere I go, on the phone for work, doing, emails, whatnot. And so enjoy this, be a kid. Yeah. And I think that, she may not like it now, but she's gotten better with it actually.
Well, no, it was the same way I was fortunate because when my kids were kind of really coming of age, the phones weren't that big of a deal. They were really just, coming around at that point. And so I don't think my kids had their first phone until they were probably 14. 15, and that was just really more of a function so I could keep up with them because they were all everywhere. But and particularly when they started driving, that was when we said, okay, you're gonna have a phone now, and then we had Life 360 so we could track where they are. So on their phone.
Yeah, I can certainly see that argument, and we're even there now where I see just them going to friends' houses and it's like, oh well, contact so and so to track them down, which is not that big a deal. I mean, that's what our parents had to do. Usually they had to go outside and yell because we were under the street lights running around doing something. But yeah, a little different.
You know the thing I miss though is
What's
like
that?
when we were growing up and you wanted to talk to a girl you had a crush on, you had to call the house
and talk to the
parent. Right? It's like, hello, who's this?
The gatekeeper.
This is Lance Roberts. Is Maggie there? But let's have a little talk here first, son.
Yeah. That's the funny thing. Michelle is a gatekeeper. I actually a couple years ago had a little boy call me.
Oh
yeah. Called
asking
me
for Abby's hand.
Hey, Mr. Ratliff, is it okay if I speak to Abby? I was like, whoa, okay. This took some guts.
That's
I like
impressive.
This kid. Yeah, and this was several years ago. But poor Michelle, they use her phone as like their phone. So all throughout the evening, it's just and these kids don't have like an off button. So if they text, we can always tell if it's an adult or a kid because the kid's like ding, ding, ding because they're just back and forth.
Exactly.
If you don't answer right away, is everything okay?
Are you mad at me?
Yeah.
Yeah, it's pretty wild.
Yeah.
So anyway, all right, off topic. Let's get back to topic. Anyway, so markets rallied yesterday on this on news that Jerome Powell would potentially end QT. This has been something that Mike and I have talked about at quite some length. Is that quantitative tightening, which was the reduction of the Fed's balance sheet, was fine up to a point that it begins to cause an economic drag, and at some point that would reverse. Well, it used to be, $25 billion a month. They reduced it by $20 billion to $5 billion a month, and that $5 billion a month has kind of been running now for a while. And now there's a big misunderstanding about how quantitative tightening works, and they're like, I don't understand this. The Fed's still buying Treasuries. Yes, the Federal Reserve is still buying Treasuries, and all they're doing is they're allowing $5 billion. That was $25 billion. Now it's $5 billion. They're allowing $5 billion a month to roll off their balance sheet. So they are reducing their balance sheet by not keeping the exact same amount of Treasuries on their balance sheet. But it doesn't mean that they're not buying Treasuries. So, for instance, they own a lot of short-term bills. 1 year, 3 years, 5 years, whatever. So as those bills or bonds mature in a given month, so let's say that this month they are going to reduce their balance sheet by $5 billion, but they have $10 billion worth of bonds mature, they've got to go out into the markets and buy $5 billion, right? So they're allowing $5 billion to roll off, but they're still buying $5 billion in the market to keep their balance sheet reducing at that same rate. So there's been a lot of talk about, the Fed's still doing QE. No, they're just managing the roll-off on their balance sheet. They're not really doing QE yet. Well, that's going to end. They're not going to allow a reduction of the balance sheet here, or this is the thesis anyway, is that they will stop allowing the balance sheet to reduce, so they'll stabilize the balance sheet. Now, again, they're not going back to QE yet, right? They're not increasing the balance sheet, but quantitative easing is increasing the balance sheet. So they're not going back to QE, but they're going to stop allowing the balance sheet, in theory, if they do this, they're just talking about it right now, from reduction. So that's going to imply that if I have $10 billion worth of bonds roll off the balance sheet this month, I'm going to buy $10 billion into the market. So a couple of things that come from this are, A, it provides support to the Treasury market. So as the government needs to issue debt to cover spending, this is going to provide a buyer in the markets, because every month the Federal Reserve has bonds rolling off. They're maturing, and so they're rolling off their balance sheet. So the Fed is going to have to step in and start buying bonds at a more aggressive pace than they were previously, which does provide a buyer of Treasuries in the resort. So that's going to help stabilize yields, and some of this concern about that bonds are going to decline, et cetera. A lot of that is going to get put under will have less pressure because of the Fed being in the game, so to speak. This also provides market liquidity. So again, this is going to be another aspect where this is an additional liquidity source for markets. And as those bonds get bought from banks, and so when those banks sell their Treasury bonds to the Federal Reserve, that provides them that excess bank credit reserves. Those can then be lent to primary dealers, et cetera, for investing, whatever. So that's how that money filters ultimately into the markets. And that's why historically we saw a very high correlation between quantitative easing and the financial markets. So there's going to be more support for the financial markets as well. And so we'll see how this works out. But again, this is just, kind of part of, this process that Mike and I have been talking about for a while, that we would eventually get back to this point to where the Fed is not reducing their balance sheet anymore, and that at some point we will actually start to see them reverse back to QE. Now, we won't get back to QE unless there is some type of event in the markets, right? You start seeing a fairly sharp decline in asset prices, you start to see real economic weakness, then that's where the Fed's first step will be, we're going to cut rates more aggressively, then we're going to go back to QE. So we're cutting rates now. But if we really start to see an economic slowdown, some type of event within the next 12 to 24, 36 months, that is more on the credit, I would say more on the credit side. And one of the kind of the aspects that a lot of people have been talking about, First Signal and some of these other kind of subprime bankruptcies that have occurred in some of the auto loan space. Those are relatively small. You're talking about $1 billion here, $1 billion there. That's very, very small. That's not going to have a huge impact on credit. It does say a lot about what's happening on the credit side of the ledger with the average consumer, but that's not large enough to create the next financial crisis, right? The area that does have that risk is private credit, private equity. So there is, and right now, the biggest tail risk event out there potentially for markets is a impact to private equity, private credit, because there's so much money chasing deals that you're eventually going to wind up with money chasing bad deals. And at some point, if that implodes, there's enough of that risk out there that could be a larger credit-related event within the markets, and that would be something where the Fed would potentially have to step in, start bailing out, whoever blew up, right, depending on the size of the firm. So again, this is kind of that first step. We'll continue to kind of pay more attention to this, but again, this is something that we've been expecting here for a while. Mike and I have talked about it numerous times, and I'm sure we'll cover it some more tomorrow. But this is that first step back towards monetary accommodation. And they've been making these little small steps. Again, we went from $25 billion a month in quantitative tightening to $5 billion a month. So we've been moving back slowly over the last, really kind of couple of years back into a more monetary accommodative type environment, which, again, reasons why markets are rallying is because every time the Fed speaks is like, okay, are they going to cut rates more? And so we keep, we got Fed rate cuts, we got past Liberation Day, the Fed cut rates, market's been rallying on that. And now every little dip, again, as we talked about earlier, investors are buying every dip in the markets on the expectation that the Fed's going to continue to cut rates and the Fed is going to continue to provide liquidity and support for markets. In the event that something goes wrong, I can take as much risk as I want because the Fed will bail me out. This is the very definition of moral hazard, which is that the definition of moral hazard is simply states that I can take as much risk as I want because I have insurance against the outcome. So think about it this way. You go to Las Vegas and you're going to play blackjack, right? But you go sit down at the table and the dealer says, it doesn't matter what hand you get, you're going to win. So how much do you bet on every hand? Do you bet everything you have on every hand because you've been insured that you're going to win? See, that's the definition of moral hazard. You've been provided, and this is what the markets believe, is they are now being provided insurance against loss. And they've been trained, and it's not surprising, right? You've been trained on this for 15 years. We had quantitative easing 1. The market, when coming out of the financial crisis, we had quantitative easing that allowed markets to rally. As soon as quantitative 1 ended, then in early 2010, it was like around June of 2010, markets declined by about 20%. And immediately the Fed stepped back in, started quantitative easing 2. Markets rallied into the next year. In 2011, we had the Japan tsunami, earthquake, rise of Godzilla that occurred, and we had a manufacturing shutdown. We had the debt ceiling debate, and the Fed stepped in with quantitative, not quantitative tightening, but
was it Operation Twist?
Operation Twist. Thank you.
Yep.
Appreciate you coming to the rescue there. Operation Twist. And so markets rallied. And then we got into 2013 when you had the whole agreement. So we had that debt ceiling deal being done in 2011. And we formed this commission that was supposed to do $1 trillion worth of cuts. Well, in 2013 was the deadline for getting those cuts done. And we had no agreement done. And so the Fed was worried about this fiscal cliff that was going to occur in 2013. And so the Fed stepped in with quantitative easing again. And we started the third round of quantitative easing at that point. Markets rallied tremendously. And so the point is over the last 15 years, every time there's been a risk, 2020, the Fed has stepped in. Silicon Valley Bank crisis, the Fed steps in. So every time there's a risk, the Fed steps in, bails the markets out, bails investors out. So why not take all the risk you can take in your portfolio because there is no risk? This is the belief that is in the markets now, and this is why you see so much speculative activity and why we see markets deviating so much from long-term means. And not just in stocks. It's in stocks, it's in precious metals and Bitcoin. It's in basically every, small caps, mid caps, emerging markets. We're seeing these very big deviations from long-term means because there is no risk of loss in assets because somebody's going to bail something out along the way. And so, again, this is why the markets rallied yesterday and why markets are up strong again this morning is because of this expectation now the Fed's going to start providing more support.
But that concept is a bit concerning. I mean, we have seen large dips within those timeframes, right? 2020, 2022. You've had, 2018, we had the worst fourth quarter since Great Depression. So it doesn't insulate you from that. And the issue, I think, what comes to it, Lance, is that psychology aspect is that at some point everybody feels this way until they don't. And then everybody heads for the exits at the same time.
Right.
And that's, I think, what will likely be the challenge in the future, which managing money right now, albeit it's been a great year, it's a challenge, right? How do you put new money to work? You know, it's...
you just buy it.
Oh, yeah, of course. Until you don't. And I think Friday was kind of a wake-up for a lot of people. I think we're like, whoa, hey, this dipped quick. And, you know, we flew past that 20-day moving average right down to the 50. And, you know, like you were mentioning, we got to get back above the 20 to keep that momentum going. And it seems like day to day, I mean, yesterday's a great indicator of that as well. You know, market's down, then it's up, percent, then it's down at the end of the day.
Right. Well, and again, it's just, volatility is something that's part of the markets. And again, the volatility risk is going to be for investors now is that, we're no longer going to see days where when you have a down day, it's not going to be, 0.5%, those type of things. We're going to start seeing more of these where markets are down 2.5%, 3% in a day. And that's because of the function that sellers live higher, buyers live lower. And we've talked about that before. But, again, that's just going to be the risk. And a good question in chat is, what would a failure in Fannie Mae type loans affect the economy? Yeah, that would have a huge impact. But again, when you're talking about mortgages, right, what you're talking about is people not paying their mortgages. And that's, so you go back to the subprime days and, if you weren't around back then, we had all kinds of crazy stuff going on in the mortgage market. We had ninja loans, which were no income, no jobs. It didn't matter. You just filled out an app. It didn't matter. And people would just give you a loan to buy a piece of real estate. And so it was not surprising that people were buying homes that they literally could not afford. Now, Fannie Mae, Freddie Mac are a little bit different. They do have very low levels of down payments, right? So you can get a down payment through a Fannie Mae or Freddie Mac mortgage at 3% or 5% with a very, very small down payment, which I think is a mistake, but that's a different story, different conversation, different day. But you can get, a very low down payment mortgage, but you still have to qualify through that process. So, what you're looking for there is you're going to need mass a very large pickup in default rates across those mortgages. And I'm not saying that can't happen. And there are so many of those mortgages out there that it could potentially cause an issue in the economy, similar to what we saw during the financial crisis. But again, you've got to separate out the subprime issue from the financial crisis. If Fannie Mae starts to go, remember, first of all, Fannie Mae loans and Freddie Mac loans have an implicit guarantee right now, at least, by the government to be paid. So even if the borrower defaults, the mortgage will be paid because there's an implicit guarantee because basically the government owns Fannie Mae, Freddie Mac, Ginnie Mae, right? So this is the whole thing. If I buy a Ginnie Mae bond, it has a de facto government guarantee of payment. It's like it's a Ginnie Mae bond is as secure as a U.S. Treasury in terms of payment. It will get paid regardless. There is an implied implicit guarantee in Fannie Mae and Freddie Mac because the government owns them, at least for now. Now there's talk about spinning those back off again, making them private. But as of right now, there is a implied implicit guarantee that those bonds will be paid because the government owns them. So you have to remember that it wasn't just the defaults in 2007 and 2008 that led to the financial crisis. That was the catalyst for the financial crisis. And what really was the problem is when the Federal Reserve forced Lehman Brothers into bankruptcy. That's what actually caused the financial crisis to be as sharp and dramatic as it was. Because prior to that, yes, the market was declining. We were having these subprime issues crop up. There were, small regionals and others that were getting underwater, going out of business. And those type of risks were occurring. But it wasn't until the Federal Reserve forced Lehman Brothers into bankruptcy that caused the big drop in the markets. And that was because all of a sudden everybody said, I'm not trading with anybody. There was the counterparty risk went through the roof overnight because nobody knew at that point who was going to be the next guy to get forced into bankruptcy. So basically the credit market stopped functioning. That's what caused the financial crisis. The subprime was the catalyst. And again, remember we had Bank of Bear Stearns got sold off it went bankrupt, lack of a better term. But it got sold off for $2 a share back in March of that year. And then the markets recovered. It's like, okay, Bear Stearns, major firm, by the way, basically went bankrupt, got bought out, $2 a share, and the markets recovered. And then
they renegotiated at like five, but
times.
it was 172 in March, and it goes in May.
So it got sold off, and then the markets recovered. Actually, got back to all-time highs in the markets before the kind of the next phase. And the market started declining a bit. We started seeing more risk, more structure, those type of things. But again, if you go look at a chart of the market during that, you'll see this kind of in 2008. You'll see this kind of steady, normal kind of bear market we were going through with the subprime crisis. But at the moment you shut down Lehman Brothers, there's a dramatic drop in the markets. And then that was where really kind of the whole thing came apart. So, in terms of where we are today, a mass kind of delinquency in Fannie Mae, Freddie Mac would certainly cause concerns to go across the entirety of the mortgage market. It would certainly impede on the economy. It would certainly cause a bear market in equities because it would pretty much dramatically change the outlook for expenditures and capex and all these type of things. Because again, if you're having a big pickup in defaults and delinquencies in Fannie Mae, Freddie Mac mortgages, that's telling you a lot about the economic outcome, right? So you're going to be in a recession at that point. But is it going to cause a mass failure in banks and mass shutdowns, those type of things, like we saw in the financial crisis? That answer is going to be no, because those loans are going to get paid. So the end borrower is going to be made whole at some point. So, the end owner of those bonds get made whole. So anyway, it's a good question though. But it would cause. If we see that, and I don't expect, and by the way, I don't expect to see that occur, but if something like that would happen, and again, that's why I think the bigger risk right now is in private equity, private credit, because you have so much money chasing those markets, so many deals are getting done in those markets that are not of high quality. Too much money chasing too few deals. That's what's going on in that market. There's a lot of risk there. Right. And so I think if we're going to see any type of real risk to markets within the next couple of years, it'll be a blow up in, the private credit space, probably most likely. Private equity is probably secondary to that. But that's where kind of the biggest tail risk probably occurs.
You think this is similar like SPACs, or is this going to be something way different? Because SPACs went out just, hey, open checkbook, right? Mm-hmm. Hey, give us your money. We'll figure out what we're going to invest in. And kind of very similar, right? People are doing a lot of bad deals, and most of these SPACs didn't make any money.
Right.
Do you think it's very similar in that aspect?
It'll be like that, but it's a lot larger.
Yeah. That's the funny thing. Nobody, SPACs just kind of disappeared for a while.
Yeah.
And, but they didn't do well.
They didn't do well, but but SPACs were a very short-lived environment.
Yeah.
And it wasn't to the magnitude of the trillions of dollars that we're seeing in private equity, private credit.
That's fair.
And more importantly, and I just posted this graphic the other day. There was an interesting piece of analysis. I can't remember who it was from, Liz Ann Saunders maybe from Schwab, but the comment is there are more private equity, private credit firms than there are McDonald's in the United States. There's like 17,000, don't quote me on the numbers, but it's like 17,000 private equity, private credit firms and only like 14,000 McDonald's. So, basically you got one on every street corner.
Yeah.
Is some guy. And the point about that is that you just have everybody's like, oh, that's the hot deal right now. So, I'm going to go hang my shingle, raise some capital and start doing private equity, private credit. So again, and I'm not saying that all deals are bad at all, right? But, you're seeing this move right now by BlackRock and others. They want to get private equity into your 401k plan. Why? Why would BlackRock even be concerned about getting private credit or private equity into your 401k plan? Is it really to give you access to an asset class, or is there a benefit to them? And the benefit to them is it gives them more people to sell private deals to.
Well, there's probably two benefits. Number one, obviously monetary. Number two would be that there's a lot of deals that they may not want to do.
Yeah. So I can shovel it off on
hey,
retail.
you know what? This isn't bad. Take a look at this.
Yeah.
And they're able to scale that. And that's the unfortunate part, is that I think that everybody gets so excited, like, oh my gosh, we're going to be able to do this. This is such a great thing. But is it? Because think about, what are the requirements to do private equity? Mm-hmm. You know, most of the time you're going to have $250,000, $300,000 in income, $1 million in net worth, excluding your residence. And a lot of people just don't have that. And those kind of guardrails are there for a reason, because number one, there's not a ton of liquidity. So for them to offer that type of liquidity, you're probably not going to get as good of a deal as you do it on your own. So you think you're going to invest like the big boys, is what I keep hearing. That's probably not the case. It's going to be very watered down. There's going to be a lot of fees on top of it. And unfortunately, what I fear, Lance, is that they may be the only people that really make a lot of money in that type of deal.
Yep.
There's going to be some good ones, don't get me wrong. But having access to that and blending them together, I don't know.
Well, and the other problem is when you create something like this, and so we give everybody access to the same asset class. The one thing that makes private equity, private credit good, or at least it was very good and gave you good returns, was scarcity of the deals.
Correct.
So people would find really good deals, they would package them up, they would do private credit, private equity deal, and it was good. But when you start having to do every deal that comes along just to fill a pipeline, you reduce the return structure. So the outsized, so what'll happen over time is that basically you'll take this lockup risk in private equity, private credit to get the same return you would get just buying a market of stocks. So you'll just dilute the returns over time. They'll begin to underperform. You'll have some other type of risk. So, but again, this is always the kind of the last stage of an asset development, when things get to the point to where it's like, oh, we're going to give this to everybody, regardless of the risk, right? We're not even talking about the risk you take by getting into these deals. But when you start giving it to everybody, you wind up with lower returns, more risk than you would have otherwise. And this is just part of the process. Again, just if I've got to give everybody access to something on an equal basis, I've got a lot of money coming into it. I've got to fund every deal that comes along, good, bad, or indifferent. And then you have to think about it from a BlackRock's perspective, or from a big institutional investor. They're going to cherry pick the good deals, and then all the deals they don't want to do are the ones that wind up in your 401k plan. And so you're not getting the pick of the deals in a lot of cases. Well,
that's a great point. So most of these funds are going to have a limit. They're only going to take X amount of dollars. Mm-hmm. And now if they have to do it for everybody, what does that look like? Most of the time, they're cutting that off at a specific point and creating a new fund. Do they still have that flexibility, or are they just going to say, is it going to look like a mutual fund? Hey, we'll just create more shares.
Yeah, it'll be a lot like a mutual fund. And again, your returns will become
like a mutual fund. Yeah.
And
but
so,
with higher expenses, I'm sure.
Higher expenses, potential lockups, those type of things.
So do you think this is something that's really going to take hold, or is this going to be kind of like the,
I think they're look, BlackRock has $13 trillion under management. They have a big sway on the SEC. They'll definitely get this pushed through at some point.
But look at ESG funds, right? They were such a hot commodity for a bit. And then everybody realized.
And BlackRock forced that through.
Yeah.
Got it into your 401k plan.
That's right. And fees were double. And it looked almost identical to the S&P.
Exactly. And they died a very quick death. And I kind of suspect that's what's going to happen with private equity, private credit, is that this is kind of the peak of the bubble. So you'll get everybody into this right at the peak, and then you'll have a big reversal, and then this will kind of
it'll peter out and just kind of disappear.
Yeah, it'll kind of disappear.
Yeah, interesting.
And it'll go back to where it should be. These should be much smaller deals, and much more finely honed and very specific, and your returns will be a lot higher.
My concern is who gets burned in the interim.
The retail investor.
Yeah.
Because that's who we're going after now. We're going after the retail investor because this is the final frontier. I've already tapped out. Think about it this way. Even the institutions only have so much money, right? And if you've tapped most of and just think about it from BlackRock's perspective. I've sold every deal I can to every person I can sell money to. I need a new source of revenue. I need a new source of blood. They're like Dracula, right?
Yeah.
So, yeah. Bloodsuckers. But they need a new source of blood. So, the retail investor is the guy you go tap for that.
It makes sense.
Yeah.
Unfortunately.
So, all right. I'm just kind of reading through chat a little bit, just to make sure I'm not missing any questions. No.
Oh, man.
They're off on an entirely different tangent on chat today. So if you have nothing else to do, read chat, because it's an entirely different conversation that goes on in chat versus what's actually happening on the show. So
you got to love it.
All right. Danny, got anything you want to cover today?
No. So, right now, this is the time of year where we are looking a lot at Roth conversions. And the IRS is actually going to start forcing a lot of people to start contributing to a Roth if you're contributing to a 401k and over 50, making catch-up provisions. So this will be something new for next year. Currently, if you're over 50, you can contribute $23,500 to your 401k, and you make an additional $7,500 catch-up contribution if you're over 50 years old. Now, there's actually a new caveat that you can do a super catch-up provision if you're between 60 and 63, kind of a weird deal where you can contribute another $11,250. Well, currently, you can contribute all that to your pre-tax, your traditional IRA. And next year, they're actually going to start requiring all catch-up provisions. If you make more than $145,000, they're going to require that you put these funds into a Roth 401k. So pay the taxes now. And then you're going to have these funds that are going to grow tax-free. Now, a lot of people will make arguments on, is that good or bad? I'm hearing a lot of kind of noise around, this is a terrible deal because you're not going to be able to save this money pre-tax any longer. And of course, what we always hear, you're going to retire at a much lower tax bracket, which I can assure you is not always the case. And we spend a ton of time each and every year visiting with people who are thinking, oh my gosh, how do I get money out of this pre-tax 401k, IRA, and into something like the Roth? So while you may not like this may be a blessing in disguise. This can actually be a really good thing for you long term, give you a lot more flexibility. I think, one thing right now is that a lot of people, there's a phase out for Roth IRA from an income perspective. And so if you are married filing jointly, if you make over $236,000, you can't even contribute to one. Well, you can, but when there's a phase out, once you get over 246, then you can no longer contribute. So this is something that I think we need to kind of flip the switch on and say, okay, maybe this isn't such a bad idea. Because if you hear Rich talk about things from a planning perspective, or we talk about often, some of the things that how to keep more money in your pocket long term, avoid IRMA charges. That's your Medicare premium surcharge if you have too much in income. Reduce Social Security taxation. This is a great way and a great tool to have in the toolbox. A lot of times as we're visiting with accumulators, the question is, what's the hierarchy of savings? How much money can I put aside and where should I put it? And I don't like that they're requiring this, so to speak, but for many people, I think they're going to look back and say, okay, this isn't such a bad thing. And so this will change each and every year. We're going to see a bump in this. It's going to be inflation adjusted. And here's the one bad thing that I do not like. If your employer does not offer a Roth IRA, Roth 401k, you can't make catch-up contributions. So this is the worst part about this whole gig, is that if they don't offer it, you can't use it. And so one thing, though, that is good is that new studies have shown Fidelity currently, they say that 95% of Fidelity 401ks offer a Roth IRA. Vanguard's at like 86%. So there's probably not a whole lot of plans out there. And I have a feeling that most employers are going to be scrambling to add that Roth 401k provision. But if they don't, and you're near 50 or over it, I would certainly start banging on HR, your benefits group door, saying, hey guys, we need to get this done, because you're going to be limited to just your normal contribution if they don't offer that Roth and you make too much money. So I think this could be a positive thing. Lance, you hear us talk about it often, the Roth 401ks. This also may be an opportunity to kind of look at how you invest. And, if you're in that Roth versus traditional IRA, Lance, we talk often about, should you put stocks in one particular account or fixed income? this could be a great opportunity if you have those Roth funds and you want them to grow long term. You're also not required to take required minimum distributions. So another great benefit from that is that you're not going to have to take those RMDs. And if you want to use it as a legacy asset, potentially, it's going to go to your kids. And with Secure Act 2.0, there's that new 10-year window that non-spousal beneficiaries must take all IRA or retirement funds out of the account. Well, now they could do so tax-free. So we want to think about long-term legacy planning. That may be another great tool to have as well. But lots of rules changing on a regular basis. And this is just one of them that I think that was going to catch a lot of people by surprise next year.
All right. If you've got any questions or comments, of course, get by the website, realinvestmentadvice.com. Just send Danny an email with that, and he'll be more than happy to help you out. Of course, while you're there also, make sure and like and subscribe to our channel. We appreciate it very much. And, of course, we'll be back tomorrow with Michael Leibowitz for Think Tank to go more into detail about Jerome Powell, quantitative tightening, potentially also what's happening in the bond market, stock market, and more. We'll get into all that tomorrow with Michael Leibowitz. All right. Have a great day. Get by the website, realinvestmentadvice.com, and we'll see you tomorrow.